Welcome back to the Stuff About Money podcast. I am Erik Garcia, certified financial planner, and your host for today. I have a guest. I hesitate to even call you a guest, Dr. Matt. I mean, you might as well be a co-host. We might as well put your little cartoon figure on our podcast
Oh, that's
art
so nice.
because I mean, you spend so much time with us. But it
It's
is,
been a while.
yeah, the one, the only Dr. Matt Morris, family therapist, couples counselor, back to the show.
Thanks. Thank you for having me back. And yeah, there's a lot of overlap between what you and I do. Surprisingly, we've discovered over the years. So I'm happy to have this discussion with you. What are we
Yeah.
talking about?
Oh, what are we talking about? I think you know what we're talking about. But the overlap, yeah, I think as this episode unfolds, you will see the overlap. I was in the middle of a conversation yesterday. Actually, it wasn't the middle of a conversation. It was a passing. It was one of those really quick passing conversations that lasted 90 seconds. I was passing by a friend in the hallway, and just kind of the core, the obligatory, "Hey, how are you doing?" type of question. I'm like, man, I'm doing good. It's a pretty busy time at work. I'm having a lot of conversations with people. And he goes, "Oh yeah, the stock market's kind of doing a little crazy stuff right now." And I'm like, "Yeah, it's a little crazy right now. I am so thankful." This is what I said to him. I said, "I am so thankful that some of my best friends are counselors and family therapists during times like
Mm.
this." And his comment to me was, "Oh, so you can refer your clients to them when they're worrying too much?" I'm like, "No, no, not at all." Because of the skills that I have learned from hanging out with people like yourself in
Oh,
times of high emotion, right? So, two things in particular that I've learned that have really impacted how I deliver advice to client from hanging out with family therapists. Number one is what active listening is, like how to really listen to what somebody's telling you. And then the second thing is how not to minimize how people are feeling. And I think my industry in particular, I think we do a terrible job at, or let me say, we do a great job at minimizing people's feelings, particularly when there's a lot of volatility and uncertainty in the economy. Because we'll say something like, "Hey, Matt, don't worry about it. It's going to be okay. Hey, Matt, don't worry about it. The stock market will recover."
yeah,
And although that may be a true statement,
right.
we didn't stop long enough to listen to what is causing you to feel afraid or causing you to have that anxiety. So, anyway, thank you, Matt.
Wait. So say more about this. So
Yeah.
when you were becoming a financial professional,
Mhm.
how much did you learn about people's emotions and how people's emotions affect their money decisions?
I would say when I was coming up as an advisor in the early days, in the early
Yeah.
2000s, there was probably next to nothing about emotions. If there was anything on the emotion side, it
Mhm.
was on the sales side. How do you move somebody to do something that you
Mm.
want them to do, to buy something? How do I convince you to buy more insurance? Okay. Which it's kind of icky sometimes, but that was probably the extent of the emotional kind of talk, how to understand people's emotions.
Yeah.
It wasn't really. I would say this is becoming a more and more. I mean, there was a small group of planners who did deal in the values space. What are people's values? I would say this is a growing space right now.
Yeah.
When you and I started collaborating back in 2011, it was not nearly as common to have. When I would go to a conference, there would probably be almost zero sessions on behavioral economics or behavioral finance. Last conference I went to, man, I might be exaggerating, but 25 to 35% of the
Okay.
sessions dealt with dealing
Yeah.
with emotions. In fact, in the past few years, maybe, I don't know, 3, 4 years ago, I got a designation called the Behavioral Financial Advisor, the BFA, and it deals with just this. So this is a growing thing. But when you and I started collaborating, it was not
And
common.
what I've learned from you is behavioral finance is the idea that people don't just do what's rational with their money or what makes sense mathematically with their money. That sometimes people like me get alarmed and scared and worried, and we make our financial decisions based on how we feel in the moment or that day or that week.
Yeah, we are human. And as part of being human,
We're not
we are
robots. Yeah.
we are emotional, right? We have learned. I mean, it was a not so much anymore, but learned behavior is we had to make quick decisions sometimes. Our emotions and our feelings were alarm systems. Something's not right. Something's not right. I have to do something. I'm being chased by a bear. I have to do something. I'm being attacked by something. I have to
Yeah.
move, right? Something. And I have to act quickly.
Right.
And we have to sometimes take those thoughts and those emotions, and we have
Yeah.
to say, wait. Let me filter this. Is this, I can't not listen to it because maybe I do need to hear what I'm feeling, but maybe it's going to move me in a direction that's wrong. So,
Yeah.
um, recently as we're recording this, I don't know when this is going to go live, but a few weeks ago on August, I think 5th, I don't know, that Monday, whatever that Monday was, the stock market dropped, right? The big drop in the market. And like, this is what led to that, my comment to the individual in the hallway asked me how things are going. Um, and you and I actually had a conversation that day. And I think my comment to you was something along the lines of making a decision that impacts long-term strategy based on a short-term event is often a poor decision.
Mm.
Not
Hmm.
always, but often. So let me
Yeah.
repeat that. Making a decision that impacts a long-term strategy, and the context was investment. So making a decision that impacts your long-term investment strategy based on a short-term economic market-driven event is often a poor decision. And most of the time, it's tied deeply to some emotion,
Hmm. Hmm.
some feeling.
And most of the time, that emotion is fear. I would guess that threat is a powerful experience for us, and we're sort of wired and geared toward responding to perceived threat.
Yeah, I would say there's two emotions that I feel are the uh, strongest that typically will cause us to make a bad decision here. Um, you said fear, 100%. Fear is one of those. I mean, whenever we make decisions based in fear, I mean, you probably see this more often than not. It causes us to do something that, like you said, it's maybe something we might regret. And the other one, I think it's the like the flip side of that coin is greed, right?
Okay.
And it's amazing how the same event, the identical set of facts, can trigger the greed and fear in different people. The same thing. So
I
these are
get
the
that.
so oftentimes we're taught as financial advisors, right? How to manage portfolios, investment management. We are investment managers.
Hmm.
I think the most successful financial planners are the ones who are good at investor management.
Managing me.
Managing you, managing
Hmm.
client, managing myself. Like I am human. Like I'm sitting here speaking both as a financial planner, but also as an investor, right? I have fears and I want to make a lot of money. So these are things that I have to tame in myself as well. So yeah,
Yeah.
100%.
Yeah. So let me back up and
Yeah.
say, I reached out to you personally and was like, "Hey, man, should I adjust my portfolio should, on August 7th?" And I bet you get a lot of those kind of calls. I don't know for sure, but I bet you get a lot of those calls when the stock market is doing something wild, when there's a lot of volatility or news about the stock market.
Mhm.
Um, just can you just sort of in a short time frame recap what's going on in the stock market or what's been happening?
Yeah. I'll kind of keep it high level because first, let me say this: the stock market is complicated.
Yeah.
I mean, like it is like think of like the most complicated client that you've ever had, the biggest ball of emotions, full of contradictions, full of irrationalities, full of like
Yeah.
just illogical thoughts. That's the stock market. Like all of that balled up. I heard one person say if the stock market was ever diagnosed it would be diagnosed schizophrenic, right, if it was a
Yeah.
human.
It's hard to reduce down to just one or two things.
Yeah.
It's a
So
big bundle of stuff.
it's just a big bundle of stuff going on. So there's a handful of things going on right now. One is, and it led up to that Monday when the stock market dropped. That one day, the prior Friday employment numbers came out, and the Federal Reserve has two mandates. People don't realize this, but the Federal Reserve has nothing to do with they don't care about stock market performance, and that their mandate is not to make sure the stock market's doing well. They have two mandates. One is to keep
Yeah.
inflation down, and the second is to maintain full employment in the economy. Right?
Yeah.
Um, when we have high unemployment in the economy, it tends to lead to recession. So there was an expectation that the unemployment rate was going to be 4.1%. Friday numbers came out, it creeped up to 4.3%. That scared people, spooked the market. So on Friday, there was a sell-off in the market on Friday. Over the weekend, you had Japan has had historically low interest rates. I think the highest interest rate in Japan this century might have been like 0.25% or maybe 0.5%, 0.5%. That's like been their highest interest rate. And over here in America, we have high interest rates right now. The Fed has increased them, hasn't started decreasing them. Okay, so you can see there's this spread in interest rates. Okay, what big investors tend to do, big money people, they go borrow money, which makes sense, at low rates. Right, Japan has had low rates, and they take it and they invest it where they can get a higher rate. Right.
Mm-hmm.
So they borrow cheap and they go invest where they can get a higher rate.
Okay.
Okay, so that makes sense, right? That's
Mm-hmm.
a good move. Well, what happened was Japan made a decision to increase their interest rates. So I think it was like a 0.25% interest rate hike that they took. Now, the problem that creates is now that spread is smaller. So you have this big money, they call it a carry trade. But essentially what happens is people have money tied up in higher interest things, and they need to unwind all that. So they start to move money around.
Yeah.
And it creates all kinds of chaos, all kinds of uncertainty. That's what happened on that Monday. That was one of the big
Okay.
drivers on that Monday. But even bigger, if we back up even more, we've seen this trend this quarter of this rotating of money outside of large cap American companies or large cap companies. Right? Everyone's heard of the Magnificent Seven stocks. It's Nvidia, Tesla, Apple, Microsoft, Amazon, Google, Meta. Right? Those seven companies over the past 12 months have been up over like 190%, some absurd number. They are driving a lot of the increase in the stock market. Well, you started to see some money moving out of those into the broader markets. So as capital starts to shift, everyone's trying to figure out what's going on. And whenever you have uncertainty, you have volatility in the stock market. And then the last thing, and I mentioned it in the opening kind of factor, is you get the Federal Reserve. Everyone's waiting for them to cut rates. Inflation has come down. When are they going to cut rates? Some people think they've gone too long, and if they've waited too long, they're going to send the economy into recession. The Fed didn't want to cut too early, because if they cut too early, then they wouldn't have inflation under control. And remember, one of their main mandates is inflation, to keep it under control. So there's this uncertainty, and again, whenever there's uncertainty, you can expect volatility, and that's like the backdrop of everything that we're dealing with right now.
Yeah. And I'm no financial expert, but I dabble in it just enough to like think I know something and really scare myself. Apparently, I remember hearing a conversation between some pundits that day, August 7th, and them saying, is the Fed going to respond to this and cut rates? And one of the pundits said, no, the Fed is not interested in the success of the market. They're interested in broader economic factors. And I thought, oh, that's so interesting that they're not as reactive as I was being in that moment. And then I was thinking about, well, what sort of stirred me up that morning? I had just, I'd woken up. It was a Monday, and probably did what I do. I looked at my phone, probably pulled up a news website, and I went back, Eric, and found some headlines from that day.
Ooh.
To Monday, August 7th. I'm going to read a few of these headlines or read a few of these statements. Dow tumbles 1,000 points. S&P 500 post. I always read it in this voice too. S&P 500 post worst day since 2022 in
Do you do that?
global market sell off. All right, now listen to this. Japan's stock market posted its worst drop since Wall Street's Black Monday in 1987, contributing to fears of global turmoil in the markets.
How do you not?
Okay,
how do you not react to that?
Listen to this one. Fears of a U.S. recession were the main culprit for the global market meltdown after Friday's disappointing July jobs report. I mean, that just sounds.
You know what's funny?
And then they throw in this phrase: investors. Investors are also concerned. So it makes it just sound like people in the know are really worried about this stuff.
So
and it sounds so dire.
Here's the irony of this. By the time this podcast drops, it'll probably be like September.
Yeah.
We'll have forgotten about Monday, August 7th.
Right.
And that's what's wild to me is number one, how do you not react to those headlines? How do they not create anxiety inside of you? And investors are like, no one called me. I mean, these headlines are running Monday morning, right?
Yeah.
I mean, who are these investors?
Investors are continuing to sell off mega cap tech stocks.
No, some of that, like that's part of that market rotation that I was talking about, that asset rotation, money moving from the mega cap, the growth into other areas. But yeah, how do you not react to that? How do you not get anxious? In fact, if I can, I talk to a lot of people, and it's interesting, just some of the conversations that I have. And I try to like prepare, and we're going to talk a little bit about that as this unfolds, kind of how the conversations that we have with people, because this is expected. The only thing certain about the stock market is uncertainty. I can tell you right now, guarantee that there's going to be uncertainty in the stock market over your investing lifetime. Okay. So let's just deal with it. And something else, this is the conversation I've been having with people for the past 4 years. Recession is always around the corner. It's always around the corner. Just like winter will be here. Will be here. Recession will come. It's part of market cycles. Okay. So when you see these headlines saying, oh, global meltdown, global recession, like, yeah, of course, recession's coming. Is it going to come tomorrow? Is it going to come in 6 months? I don't know. It's just part of, it's like, you're going to get sick, Matt. I'm going to tell you right now, sickness is around the corner. So you can choose to be anxious about getting sick, or just when it comes, and you take precautions and prepare, Anyway, I had a call with someone, this was such a wild call for me. This is fairly unique to have it in a 5-minute phone call. Okay. Phone call started with, this was on that Monday morning. Hey, what are we going to do to the portfolio and this wasn't you. So if anyone's thinking, this wasn't Matt. What are we going to do in the portfolio to reduce losses? Okay. And I talked through it. And, at the end of my recommendation was, well, nothing's really changed with your strategy. So our managers these are good managers. We're in good stuff. So we're not going to do anything. But I think
they were reacting to that, the weekends.
Probably like you picked up their phone, saw what was going on, read the news lines. And in that same, followed by, what are we going to do to reduce? So fear, what are we going to do to reduce my losses? Before I said nothing, before I kind of walked through kind of the process I typically walk with people, the following comment was, I've got a bunch of cash on the sidelines. I think I'm going to go buy a bunch of stuff.
Oh, okay.
So I had fear, and it wasn't an excessive fearful call, but it was an element of fear driving, we need to adjust the portfolio to reduce losses, to an element of greed. Oh my gosh, I can go buy some stuff cheap right now. In one conversation. So that was kind of interesting. That's
you're saying the same person was having, well, and they're saying, what can I do to reduce losses? And there's also an opportunity here.
Yeah.
Yeah.
So the there's not much you can do that would satisfy both of those kind of feelings, right? Because they're contradicting feelings that would elicit two different sets of advice. It was just interesting, and I think that's not uncommon, because that's how this stuff works, right? We're afraid, and then we're greedy. I'm using greedy kind of loosely here. I'm not saying just because you want to make money in the stock market. I'm not saying you're a greedy individual, but that idea of wanting to grow and make more, sometimes it can be problematic. We have on the opposite side, where kind of fear really just drove a decision, where we've had a couple clients who just don't want to deal with the volatility. It's just too much, where they go completely to cash, right? Where they will sell off all their equities. And those are some conversations that we've had that at the end of the day, I mean, if you're not comfortable, you got to make a decision. If you're not, you can't be comfortable. One of my favorite conversations. Oh, go ahead.
I mean, I'm getting in the weeds here, but savings account interest rates have been up recently. CD interest rates have been up recently. So is that driving some of it? Is that there is a certainty? I can put it in savings. I can put it in a CD. I think that's fairly certain, as far as I know. Is that driving some of it? Is that there are some financial instruments out there that people know about that feel more certain?
Sure. Yeah, like, why am I going to sit here and watch my portfolio lose when I can get 5% in a CD right now?
Yeah.
So that's part of the decision making. And we're actually going to talk about that here in a few minutes, when you're making a decision on how to invest a pot of money, and keeping in the context of not allowing short-term events to drive long-term decisions, right? Where we have to attach purpose with different buckets of money. We'll talk about that here.
One more thing. Do you, like, my question to you that morning, should I adjust my portfolio? Like I'm some sort of day trader or something, like I'm some sort of like person who watches the market. I never watch the market, but I happened to see the news headline that day. Do you deal with actual like day traders who really do need to think about, can I adjust to save some money or avoid some loss, but also there's an opportunity here to shift some money? Do you deal with that sort of stuff? Or most people like me that you deal with, long-term investors who don't need to really be looking at it that closely?
Yeah. So the way our practice, most of the investing that we do, if not the majority of it, is long-term. So I don't deal. I mean, I have some clients who have accounts. In fact, I make provisions for accounts that for clients that I know wanna maybe, quote unquote, play the market. I'll kind of advise them to go open up an arcade account. I call it the arcade account. I love naming accounts. It's the fun account, right? But I don't get into the advising on individual stocks. You should go buy this, sell this. Then, like, I think that long term you're mostly going to lose. The majority of the people who do that are not winning. You do hear the stories. It makes for good cocktail conversation. And here's what I have found. When someone's coming to you and they say, "Man, Matt, right? I bought Tesla when it was, before it split, and it was only $65, right?" Yeah, they bought it with $1,000. They have a total of $100,000 invested in other things, and they're not telling you the 10 things that they lost money on.
Yeah.
And that's pretty typical. That it's the fishing story, right? We're going to tell you about the big fish that we caught, and not about the failures.
Not the hours and hours where there was nothing.
Yeah. So yeah, that kind of trading, if you don't do that professionally, that kind of trading, I think for most people, do it with a small part of your portfolio, have fun with it. I don't like doing it for people because I'm not going to tell you when to buy or sell. Because, like, here's the thing: if you buy something, you got to make a second decision on when to sell it. So you have to have two right decisions. That's hard to do.
Yeah.
Then when you're doing that across multiple stocks, so yeah, for most people, particularly depending on the style and philosophy of investment management that you have, there are some things built into that strategy that are shifting with the economy.
Okay.
Right? Maybe exposing a little bit more money to certain areas that are doing better, or reducing a little bit of exposure to an area that's struggling, and they're using different styles of analysis. Maybe they're looking at the fundamentals of a company. Maybe they're doing some technical analysis, which is looking at like what.
Yeah.
Yeah, but
I don't even know. I mean, yeah, I'm not doing any of that stuff.
exactly.
So for the person like me,
Mm-hmm.
that sort of the average long-term investor. And listen, I have a lot of education. I have a career. I have expertise. I
You're
have
a
a
doctor.
doctor in front of my name, but I don't know
PhD.
anything about what you're talking about, fundamentals of a company. So what are like the helpful behaviors that I can really engage in or avoid, I guess,
Yeah.
that will really, impact my own ability to build wealth long term?
Yeah. Let me answer the flip side to that first, and then
Okay.
we'll transition into that, because I want to say this. I want to capture this. Most of my clients, I got a lot of business owner clients, and they're listening to this right now, and they're building wealth through their businesses. You're a business owner yourself, right? We have this asset that is growing. Um, so this idea of how can I best build my wealth, right? What are the decisions, the behaviors that I need to exhibit to best build my wealth? And sometimes what I like to do is say, okay, it's kind of like golf, right? How do I best shoot a better round of golf? It's by minimizing bad shots. It's not necessarily making better shots.
Mm-hmm.
I got to make less bad shots. If I make less bad
I do
shots,
for sure. Yeah.
right? If I can reduce behavior that is impacting my wealth building um, program, I'm going to be better off. So what tends to happen with these emotions that we talk to, they lead us sometimes to destructive behavior, like I think going when you have a long-term portfolio and you go 100% cash. That could potentially be destructive if you sit there long enough. I mean, I've talked to people, we're going back, who moved their portfolios to all cash in 2008 after the market dropped. And I'm sitting here talking to them in 2015, 2016, and they're still sitting in all cash. That is destructive.
Eugh.
That's destructive. And then there's
That's
disruptive.
that's opportunity cost, right? You lost
You
by
lost it.
not.
Yeah.
Yeah.
Fear drove you to do something that absolutely 100% destroyed the ability of that dollar to grow for you. Right. And then there's that disruptive behavior that causes us to, maybe it didn't lead to disruptive behavior for you, but those thoughts could have led to disruptive behavior, where in the moment you might have did something and then changed it back up shortly thereafter. So those are disruptive behaviors. We want to minimize that. Okay. And I think that there's one thing in particular that you can do is, before you make an investment decision, is to ask yourself, what is the purpose of this money? In fact, there's 3 questions that I think that you need to be doing before you invest and as you invest. Okay. So the first question is a question of purpose. What's the purpose for this money? Right. So I got
Yeah.
a bucket of money. What's it intended for?
Yeah.
This bucket of money is intended for retirement 20 years from now. Okay. In fact, the
Mhm.
second question is time frame. So the purpose is retirement. My time frame is 20 years. All right.
Yeah, and that makes sense to me in the sense that, like, I have some money that I don't want to need for 20 years, but I have some money invested that I might need in the next 5 years. Those are different strategies, right?
Yeah. And then you have some money that you might need in the next 2 years,
Yeah.
right? We're in the middle of hurricane season. You might need to get your hands on $5,000 really quick, or
Yeah.
$15,000 for a deductible really quick,
Right.
right? So that money's purpose for something short term, that's going to drive my investment decision. I don't want that money in
Yeah.
equities. I don't want it in the stock market, right?
Mm-hmm.
So if you understand your purpose for investing, if you understand your time frame for making that investment, we joked by the time people listen to this, they're going to forget about Monday the 7th, August 7th, most likely, if the
Yeah.
stock market continues doing well like it is as we record
And
now.
to drive home that point, you shared with me a chart, an image.
Mm-hmm.
You sent it to me.
Yeah.
And it was a chart of the stock market going
Yeah.
up, It was a chart of the stock market over the last several years, I guess, or last several months.
Well, it was a 12-month trailing. So it was 1 year.
A 1 year. Okay. And so back there was like a thought bubble over like May or something. And it said the thought bubble over May was like, you weren't worried here when the market was a little lower than it is, several thousand points lower than it is right now, or was in August 7th. But then there was a thought bubble over August 7th that it was higher. The trend was higher, but had dipped just a little bit. And it said, why are you worried now?
Yeah. I think it was, you were happy here, but you're scared here.
Yeah. You were happy at lower, but you're scared at higher with a little volatility. And it sort of reminded me of like, wait. I'm in this for the long haul. I'm not trying to make financial decisions on a Monday morning.
Yeah.
Based on some headlines I read.
Yeah. So the decision that you said that like, I'm in it for the long haul, you basically answered the question, the first two questions. What's the purpose of this money? Man, it is for the long haul, right?
Yeah. Right.
And what's the time frame? It is for the long haul, right? Yeah. The third question is, what's the likelihood that you're going to need access to the money before its intended purpose? This is why I'm a big fan. This is why I like financial planning rather than just straight investment management, because I like to take a higher level view of your finances that says, hey, man, if we make sure that we have the short term covered, the oh crap event, the deductible, you got to get a new roof on your house because a hurricane came or AC goes out, whatever. We have that shored up in cash. You have sufficient cash to carry you through the oh crap event. It allows you to be more confident that you're not going to need to access your long-term investments. So what it does, it allows you to take more risk. Risk isn't bad. Risk is associated with reward. It allows you to take more risk to have the potential for more growth. And we know that the stock market, the more risk you take, if you stay in the market, you're going to be rewarded for that over the long term. So that's what you did. You asked yourself, well, this is long term, or you reaffirmed that. That's why I like to ask these questions, not just at the beginning, but if you call me and say, oh, what are we going to do in a portfolio? I'm going to say, hey, or should I adjust my portfolio? I'm going to say, it depends. Is this money still intended for the long term? Yes. Okay, cool. Has your time frame changed? No. Okay, cool. Do you still have emergency funds? Are you going to need to access this anytime soon? No. Okay, cool. We're probably not going to adjust your portfolio. Well, I'm really nervous. Well, maybe we might adjust it a little bit, but we're not going to make any dramatic changes.
Now, if I say, hey, I actually do need this money in the next year, then you might get a little bit more, I don't know, active in advising me.
Well, I mean, for our clients that we do financial planning with, we're going to sit down and say, well, let's talk about that. What are we planning for? Let's make sure that we have, the appropriate buckets of money set up. What's that need that you're going to have in a year? Is it college? Is it you're looking to buy a new car? You're looking to put a down payment on a house? You're looking, recent conversation with a client. They had just started a small business, and there was some uncertainty with referrals. So the recommendation was, you probably want to hold on to more cash. We don't want to invest it. But once you have some certainty and some stability in your small business and you feel better about it, then we want to divert some of that cash into an investment account for higher growth. So, I mean, finances are constantly moving. There's constant new variables entering the picture.
And it sounds like it's very individualized to the person.
It is. There's a reason why it's called personal finance. It is. And you know this. I cringe anytime I hear prescriptive financial advice. For someone who podcasts, I'm trying to be really, really careful not to give prescriptive advice. That's why I like this format, the podcasting format, because I'm able to nuance advice rather than just like put a quote out there. Stay invested. I don't know if you should stay invested. How can I make that determination? I don't know you.
Balance of like trying to be general that applies to a lot of people, yet it all depends on your particular situation.
100%.
Yeah, okay. Same for, it's the same for my field. People ask like general relationship advice, and I can give like general principles, about healthy relationships, but it all depends also on your particular situation.
Yeah, when people ask me for general financial advice, like, hey, what should I do?
Mhm.
My default is this. I might say, like, I don't know anything about you, but here's three things. If you do these three things, there's a good chance you're going to be successful.
Yeah.
Spend less than you make,
Yeah.
save as much as you can, and don't do anything foolish with your money. I mean, that's as prescriptive as I can get.
Yeah.
So we talked about those three questions, right? And making a decision on how to invest money, and then three questions to continue to ask you as you stay invested. And your question was, what are some things that I can do to make better decisions, investing decisions? I think there's one more thing that you can do is to educate yourself on the stock market. Now,
Mm.
this gets a little squirrely here, because we all have our own biases. We all live in our own echo chambers, and unfortunately, what I'm seeing right now is as we educate ourselves, it's typically to our bias. So we're listening to people who say the things that we want to hear. So there might be some facts that people are using, right? But it's usually to support something that it's facts out of context. Okay, so educating yourself, this is a little bit challenging. You like the headlines, right? I'm going to go read more, and you read those headlines that you read off earlier. Oh my gosh, right? Whoever's writing those articles have a slant, they have a bias. So there's two things in particular that I want to talk about. Educating yourself about the stock market. Number one is understand the performance of the stock market over time, the history of performance. Okay. So there's an interesting quote from the book A Random Walk Down Wall Street. And this is what it says. This is interesting. The stock market is like a gambling casino. Okay, right there. If I stop right there, the stock market is like a gambling casino. If you're a fearful person, you're like, it's speculative, right? House always wins. I'm gonna lose.
Yeah. I remember even saying that in my lifetime at different points, like, this is just gambling.
Hmm. Listen to the rest of this quote. This
Yeah.
is fantastic. So the stock market is like a gambling casino where the odds are rigged in favor of the players. We're the players.
Yeah.
Okay. If I go to the casino, there are statistics on this, hard facts. If I go to the casino, the longer I play in the casino, the greater the chance I lose.
Yep.
The stock market is completely the opposite. It's rigged in our favor, not in the favor of the house. The longer we play, the odds are in our favor. So if you jump out when things get scary, and I'm going to tell you right now, there's rarely a time, I've been at this since 2001, and you can come to me in any year, and there's always something to be afraid of in the stock market. Always. Always. If you jump out, you're forgetting the history of the market. Well, this time it's different. This time it's different. This time it's real. It's not people have been saying that for a really, really long time. And I'm not saying that it can't be different. I'd be foolish to say my parents came from Cuba, right? They had terrible things that happened in the government there. They had to leave their country. They lost value in their currency. Can something happen? 100%. Sure it can. But are we going to live in the 5% or 2% or whatever small percent that something could possibly really, really, really bad happen? Or the 95% that historically we know that things are going to continue to progress as they've done historically in this country, in this economy?
Yeah.
Okay. So educate yourself on the history of the stock market. Okay. Don't make decisions based off of those short-term drops. If we're making those decisions in those short-term volatility, we're forgetting the history of the market. That little chart that you referenced that I sent you over a 12-month period, that was perspective. That little drop was so small compared to the run in the market. Okay.
It looked so small compared to the headlines I was reading. That's the other thing.
So yeah. So related to that is understand. Now this is fascinating. Understand that it is on average, it is common on average for the stock market to have a 5% pullback 4 or 5 times a year.
Oh.
So what that means is if the stock market is at, let's say we're in May and the stock market's up 10%.
It's at 40,000 500 today.
Okay. 40,000 was, you're going to make my math too hard, Matt.
Oh, okay. I'm
Um,
sorry. I'm sorry.
so let's say the stock market's up 10% to year to date, and we're in May. For the
Yeah.
stock market to drop back to 5%, that's common, right? It's up 7%, it drops back 5, it's down 2. That's common. That happens. The stock market pulls back and it recovers. It pulls back and it
Okay.
recovers, right? And it's
You're
not
okay.
on.
Wait. So as of this record right now, it's year to date up 7.5%. So we should expect some pullback throughout the year. I mean, even if I look at the chart, there are peaks and there are dips. So those are the pullbacks, and there's going to be 4 or 5.
We've had two pullbacks of over 5% year to date this year already.
Those are sort of expected, typical. Let's say it that way, typical.
Mm-hmm.
But if you stretch it out 5 or 10 years, you just see this more steady march forward.
Yeah. So understand, a pullback doesn't mean the stock market's gone negative.
Yeah.
It just means you've given back some of the gains that you already have in many cases. And it's not uncommon to have a pullback of over 10%. So for example, the NASDAQ, which is one of the metrics that we use to measure the stock market, had a 10%, and we call that a correction. If it drops over 10%, we call that a correction. The NASDAQ had a correction, but it's already back. It's probably recovered all of what it's given up.
Oh,
so
wow.
all that, if you arm yourself with that knowledge, and the stock market drops 3% in one day, then you're like, oh, wait a minute, this is par for the course. This is par for the course. Of course, this is going to happen. It was inevitable, right? Of course, winter is going to come. It always comes. Recession is always around the corner. So you're able to handle some of this stuff better as it comes.
Yeah.
Here's kind of the kicker is that it's important that we manage our subjective feelings, right? Because feelings are subjective. We manage our subjective feelings with facts that are objective. That doesn't minimize the feeling. All it says is, I'm feeling this. Is this true, or is there something objective that can inform that emotion? Yeah. And with the stock market dropped 3% today. Oh my gosh, I'm feeling anxious. I'm afraid. I don't want to lose. I worked hard for my money. I don't want to lose it. The objective fact is, wait a minute, this has happened before and we recovered. And you know what? It's common for the market to drop 5% 4 or 5 times a year. And this was only 3%. And the purpose of the money is long-term. It's for retirement. And I got 20 more years and I've got a solid emergency fund. Oh, okay. That emotion, I can put it to the side and move on.
Yeah. My subjective feeling needs to butt up against or be compared with objective facts. The market long-term is doing fine. This is a course correction and I have money. I've already planned all this out. I have a plan.
That's why, I think everyone needs to meet. This is, take it with a grain of salt, coming from a financial planner.
Here we go.
Here we
go.
This
like everyone me saying everybody needs a therapist.
Everybody, this is my prescriptive advice, guys. I'm contradicting myself. Is everyone needs to spend, whether you meet with a financial planner or not, everyone needs to sit down and think through their finances globally. Right? Comprehensively.
Yeah.
How does all this work together?
Right?
You make money. That money, those dollars are the building block to your wealth. They're the building block to your retirement. They're the building block of funding emergencies, funding school for your kids, funding your food, your vacation, things that you value. Right? They're your protection against calamity. How does all this work together? What's the most efficient and effective way for me to pull it all together and think through this so that I don't find myself making decisions based off of short-term events because it's touching and driving some deep-seated emotion.
Yeah.
And I would say everyone needs to talk to a counselor, maybe not a professional counselor, but a friend.
Get some counsel
someone
somewhere.
Who listens, someone who can listen and empathize and help you think through things wisely.
Can I add one more, more like psychological counseling-esque perspective to this that we're talking about?
Sure.
Okay. And this is now like our fields overlapping.
Okay.
I think if you're going to be an investor, and most of you should, if you're going to be an investor, you also need to notice in your own life how fear and alarm influence your decision making. Fear and alarm affect us, as they should. I mean, they're important indicators of threat. And so if we're going to really try to plan out our money in a comprehensive, thoughtful way, we have to notice in our own lives how fear and alarm influence our decision making. When I read that headline, which I didn't know anything about 3 minutes prior, and then I read the headline, and then I thought, oh my God, I need to text Erik. How do fear and alarm influence my decision making? And that can be financially, but in my field, it's often relationally. Fear is a very effective driver of like behavior change.
Yeah.
And so if I'm tending to be reactive in my own life, if I tend to worry and get scared and then make decisions, I need to know about that when I'm also investing my money. Or as it turns out, and this is something you and I have learned together over the years, our emotions matter in how we invest and spend our money.
They do. Man, I think that's a good way to end this episode here. But yeah, so to answer the question, to go back to, should I adjust my portfolio?
Yeah.
It depends, y'all. It depends. I don't know. It depends. It depends on the purpose for your money. It depends on your time frame. It depends on how much money you have in savings, how much liquidity you have, how much debt you have. There's a lot that goes into making these financial decisions. And your money is important. Your dollars are important. They are the building blocks to building wealth. I talk a lot about building financial security, because we all want to be safe, right? Security is safe. And in our society, we're not living 500 years ago where safety was, or maybe in parts of the world where safety is in people, maybe security is in the community.
A wall and a moat. And a moat. Yeah. Safety. Yeah.
Safety is, having money. You need money to make it through, and security. Yeah. And we don't want to disrupt our wealth building efforts through poor decisions because of an emotion, a short-term event. And that is as true in investing than anything. So Matt, as always, appreciate your professionalism, your wisdom, your expertise.
Well, thank you. Today I was, I was the one wondering, should I adjust my portfolio? So thank you for your expertise and all that you do to help us all build wealth.
Awesome. All right, y'all, go out there, plan wisely, and live confidently. Thanks for listening.